Welcome to Series 7, a learning tool from Securities Training Corporation. I'm Michael Quinlan. Each tape is designed to improve your understanding of a topic that is essential to your success on the Series 7 exam. Throughout this program, I encourage you to use the video technology available to you. Pause, rewind, and slow me down when you want to review more carefully. As you probably have discovered, studying this material takes a lot of concentration, so you should take breaks when you feel a need. Allow about 2 hours to complete this tape. If you have questions on the topics discussed in this program, we encourage you to contact your local Securities Training Corporation branch. You can find the telephone number in your study materials. If you would like additional materials or tapes, call 1-800-STC-1223. We have a lot of material to cover, so let's get started. The topic of this program is fundamentals of options. Now, before we get into the detail of options, let's go back and talk about and review a typical stock trade. Now, what if we have a stock trade set up with this particular type of information? So, for example, in this situation, someone is going to be buying stock and someone is going to be selling stock. They have agreed to a transaction. Now, a trade, it's important for us to see, is actually a contract between these two investors. And we see the terms of the contract set here. In this particular case, the two investors have agreed to exchange 100 shares of XYZ stock for $5,000, or $50 per share. But notice that will occur on the third business date following the trade date, which is the settlement date. Now, things can happen between the trade date and the settlement date to the value of the stock in the open market. That will affect the opinion of the various investors involved, the person buying and the person selling the stock. But notice that since this is a contract, they still must complete this transaction on the third business day following the trade. Let's take a look at some circumstances that could occur. Now, what if the day after the trade the stock fell to $10 per share? Now, this turns out not to matter for this particular contract. On the settlement date, the seller still must deliver the 100 shares, and the buyer is still committed to paying $50 per share, even though the stock in the open market is now really only worth $10 per share. Obviously, the buyer of the stock isn't going to be too pleased with this outcome. On the other hand, what if the day after the trade the stock rose to $90 per share? Again, if that happened, the contract still must be settled under the original terms, that is, at $50 per share. So the seller is still going to have to deliver 100 shares agreed to in the original trade and receive $50 per share, even though in the open market the stock is now worth $90 per share. So in these particular cases, I think that we can see that one of the parties is not going to be very happy about what happened in the transaction. But because this is a contract, the two parties involved are still bound by that contract regardless of whether the stock fluctuates up or down in the market after the original trade occurred. They have to go through with the settlement of the original transaction. Now, this is because a common stock transaction is a contract between these two investors that contains certain terms. And any contract is really just an agreement between two parties in which each party gets something out of the contract and each party has to give something up. And as long as both parties agree to the terms of the contract is valid and its terms can be enforced. But there is no reason why we couldn't alter the terms of our normal contract to suit the investors who might be interested in some other kind of arrangement. So that's what we're going to do here. We're going to take a normal stock transaction contract and adjust it a little bit to suit the conditions that we're looking at, where one or the other investor wants to change the terms from what we would normally see. So we're going to create a new contract between the buyer and the seller of the stock in this particular case. Let's go through what this contract says. Now here, the contract again is for the exchange of 100 shares of stock at $50 per share. But now, it's only if the buyer wishes to do so. So notice that this exchange of money and securities will occur only if the person, the buyer of the stock, wishes to go through with the arrangement. Now let's try to imagine what might happen later on. For example, suppose the stock were to rise to $90 per share. If the stock does, remember our buyer still has the right using this contract to purchase the stock at only $50 per share. They will then, upon going through with that deal, own stock that in the open market is actually worth $90 per share. So it would seem rational for the buyer to say, yes, I do want this stock. I wish to complete this trade, and go ahead with the transaction. On the other hand, what would happen if the stock fell to $10 per share? Well, it is likely that the buyer will back out of the arrangement in that particular case. Why would you buy stock at $50 per share when the stock is really in the open market only worth $10 per share? Now remember that the buyer of the stock in this case is not required to go through with the transaction. The exchange will occur only if the buyer wishes to do so in this particular case. So it's likely that the buyer says, no thanks, I really don't want to go through with this deal in this situation. Now we would say in this situation then that the buyer has a call option. That is, it is the buyer who has the option of completing this trade or not. If they decide to go through with the contract, then the trade will be executed and money and securities will change hands. If the buyer says, no thanks, I don't want to go through with the transaction, then no exchange of money or securities is going to occur at that point. Now again, the buyer and the seller of the stock have to agree to this arrangement in order to make it a valid contract. You can't have one party saying, well, I want it to work this way without the other party agreeing to it as well. But once the two parties do agree to this arrangement, notice then that the buyer has a lot to say about whether the trade will occur or not. Now we did change our initial contract in a certain way to give the buyer a call option, and the buyer then decided whether the exchange would ever occur. We could change the contract a little bit, or more than a little bit, in a different way and give the seller more say in what happens. So let's take a look at an arrangement like that. Imagine a slightly different agreement in this contract between the buyer and the seller of the stock. Now notice in this case, the arrangement is basically the same. We might eventually exchange money and securities between the buyer and seller of the stock, same 100 shares, same $50 per share price. But now the key difference is that this will happen only if the seller of the stock wishes to go through with the arrangement. So let's try to imagine when we would complete this arrangement. When could we complete this transaction? Well, that would occur if the stock fell to $10 per share. What would happen then? Would the seller of the stock choose to go through with the deal on a stock that they could sell for $50 per share? Well, probably. Now, remember, the stock in the open market is really only worth 10. Yet using this contract, the seller of the stock can complete a trade in which they can receive $50 per share. So it would seem likely under these circumstances that the seller would say, yes, I want to complete the trade. On the other hand, what is likely to happen if the price of XYZ on the New York Stock Exchange rises to $90 per share? So if we have the stock, which the seller does, the seller has the choice. They can sell on the open market for $90, or they could use their contract and sell it for $50. So of course, what kind of trade do you think the seller would make? Well, they would not want to go through with the contract, but instead, they will sell their stock in the open market at a much more attractive price. So in this circumstance, the seller would cancel the trade, and then they will arrange a trade somewhere else. So in this situation, we would say that the seller of the stock has a put option. So a put option, notice, gives a lot of control over whether the transaction occurs or not to the person who has the stock and might want to sell it. And with the contract, they always have the right to sell their stock at $50 per share. But notice they don't have to go through with that arrangement unless it is to their advantage. If they find a better deal somewhere else, they can sell the stock there and ignore this contract. They only have to sell if they wish to do so in this situation. So what we've looked at are two basic types of options that exist in the market, and those are the only two types that are really out there and available that are of concern to us here. Notice, though, that in each of the contracts, there were two people involved. One person who might be buying stock and one person who might be selling stock. The real difference between the two contracts is who's in control. Who decided whether that transaction could occur or not? In the call option was the person who might be buying stock. In the put contract, the control was in the hands of the person who would be selling the stock. So that's why we have two different contracts with two different kinds of situations in which control is given to different parties involved. Now, you can arrange these types of transactions between yourself and any other investor. Again, who is willing to agree to the terms similar to the ones we outlined here? However, there are advantages to investors using what we call here a standardized or listed option. Now, that is the type that we're going to focus on in our program today. What we're going to look at is contracts that trade on option exchanges such as the Chicago Board Options Exchange, CBOE, as well as many other options exchanges. And there are several others that exist around the country. These types of contracts, again, are called standardized or listed options. The values or terms of the contract can't be anything that we would like. They are standardized. and can only take on certain values that are permitted by the exchange on which the options are traded. So let's take a look at one of these and consider the following contract. In this example, we have an option, in this case a call option described as XYZ January 50 call. Now the first component here is the name of the stock involved, XYZ. This is called the underlying stock. Now we assume that if you have such a contract and you remember you have the right to buy this stock if you own this contract, that you will have the right to buy one round lot, that is 100 shares of the underlying stock. So that is the assumption that we make with one standard option contract. The next component is a date. And notice it says January. That's the expiration date. As of the expiration date, this contract would be null and void, and the person who owned the call would no longer have the right to buy the stock. So you have to use this right if you choose to do so before this expiration date. Now, the actual expiration date is a detail that you should learn from reading your manual. We won't go into those details here, but suffice it to say that this expiration date is about the middle of the month. The third feature of the contract is a price, in this case, 50. Now, this is called the strike price. The striking price, or the exercise price. Now, we'll be talking about this term quite a bit, so we're going to use an abbreviation for this particular figure, XP. Think of exercise price when you think of this particular symbol. Now, this describes the amount that you would have to pay in dollars per share if you decided that you wanted to go through with this particular contract. So it's going to be this price in dollars times the number of the underlying shares. So altogether, to buy the stock in this particular contract, you would have to pay $5,000. But we usually think of the exercise price as the price per share that you would be paying to go through with this contract. Now finally, we are told that this contract is a call option. This is the type of option, and there are only two types of options, the call contract, which we have here, and the put contract. Now each contract, as we saw, involves two parties, one of whom might be buying the stock and the other who might be selling stock. The contract will only be completed, though, if the person who has the right to decide goes through with that right. Now we're going to be referring to these parties quite a bit in our discussion, and so we have to have some vocabulary to describe who they are, and we also have to understand basic definitions of their rights in the contract, and that they are required to do so. It's important for us to review those ideas. Now, since each type of option then involves two parties in the contract, one of whom might be buying stock and the other of whom might be selling, if the deal goes through. In the case of the call option, the person who has the right to buy the stock is said to be the owner of the call. And when you think of this, when you think the owner of the call, you should immediately be able to think, these are the people who have the right to buy. These are the key terms here, a right to buy stock, and what they have a right to buy, in this example, is 100 shares of XYZ at $50 a share until the January expiration. So there must be someone, if they decide that they want this right now and they want the stock, which should provide the stock on demand. Now, this person would have an obligation to sell. So notice, for a right to buy, there has to correspond to that an obligation to sell the stock. We would call this person the writer of the call. Now, unfortunately, as it turns out, these are not the only terms that apply to the person who has the right to buy and the person who has the obligation to sell. One of the things that you'll have to get used to in this area is to be able to use several different terms interchangeably. And that's just one of the things that occurs in this industry. The vocabulary has been developed that has a lot of different terms that are really synonymous. So we need to be familiar with all the terms and use them interchangeably. So, for example, the owner of the call, the person who has the right to buy, is also known as the buyer of the call, the holder of the call, the purchaser of the call, or is said to be long a call or to have a long call. Now, all of these terms are interchangeable, and so if you see a term and you're not very comfortable with it, let's say long call, and you have a better understanding of what owner of the call means, then substitute one for the other. For example, mentally, while you're reading through a problem, you could use these things interchangeably. Now, the writer of the call is also referred to by several different terms. The writer of the call is said to be the seller of the call, or they're said to be short a call, or to have a short call. And again, these terms are interchangeable. Sometimes writer is often the clearest term, So if you see any other term, simply substitute the writer of the call for those and think that this is the person who has the obligation to sell stock in this situation. Now notice that there are not two different types of calls here. Even though we see a long call and a short call, really there is just one call. The long and short simply refer to the two people who are involved in the contract. The person who is long the call is the person with the right to buy stock, and the person who is short the call is the writer of the call, and they have the obligation to sell the stock. So we need to think about those terms and what they really mean whenever we see them in a problem on the exam. Now, as with call options, there are two participants in each put option contract as well. But who owns the contract in the case of a put option? Well, that's the person who has a right to sell the stock. Notice that the owner of the put is the person with the option, meaning the person who has a right to do something. In this case, a right to sell 100 shares of XYZ at $50 per share until January expiration. So what we have to do to associate then, these terms, owner of the put and the right to sell. Now, if this person does want to sell the stock, to whom is the stock sold? Well, there must be someone who is obligated to buy the stock on demand. So again, for every right to sell, there has to be a matching obligation to buy. Otherwise, this right just doesn't make any sense. So this person would be called the writer of the put in this situation. The owner of the put has the right to sell, and the writer of the put has an obligation to buy 100 shares of XYZ at $50 per share until the January expiration. As with the call option, there can be several different terms that can be used to refer to each participant. So, for example, the owner of the option, in this case a put option, is also called the buyer of the put, the holder of the put, the purchaser of the put, or is said to be long the put. So notice that anytime we describe someone with this particular description, we know that they have the right to do something. The only question is, the right to do what? Long call means the right to buy. Long put means the right to sell. Now, the writer of the put is also called by several terms. They're called the seller of the put, or said to be short the put. But again, whenever we see this term, we think, well, this person has some kind of obligation to do something. In this case, this person has an obligation to buy stock. So again, there are not two different kinds of puts here. There is only one kind of put contract, but there are two different people who will participate in the contract. The person who is long the put is simply the person who has the right to sell something in the contract, and the person who is short the put is simply the person who has written the put and has an obligation to buy in that case. So sometimes we tend to forget one side of the contract when we're concentrating on the other side. But keep in the back of your mind that every single option contract involved two people participating in the arrangement. And if they didn't agree to the terms of the contract, there would be no put option for us to discuss. Now, what we've reviewed is the basic meaning for each type of option. We're going to review call options in more detail, and then later we're going to go back and come back to put options and discuss those as well. Let's use the example that we described earlier. In that case, we had an XYZ January 50 call option. Now remember that for each option, there is someone that owns the option. They have a right to buy. And there is someone who has written the option, and they have an obligation to sell. Now, let's first take the viewpoint of the call owner. Suppose that XYZ stock was currently worth $54 per share on the New York Stock Exchange. Now, remember the call option that we're talking about, though, has a fixed strike price of $50. But the value of the stock can, of course, fluctuate in the market. So we're assuming right now that the stock is at 54. The owner of the call has the right to buy stock at $50 per share. If the owner of the call demands that right, that will be termed an exercise. So they would have the right to buy the stock, and they would go ahead and do so at $50 per share. Having purchased the stock at $50 by exercising the call, the investor could then sell the stock in the open market for $54 per share, a higher price, and of course, taking the difference for a gain. Now suppose instead that XYZ stock fell to $48 per share instead of rising. It makes no sense for the call owner to demand their right to buy stock at $50 when they could go into the market and buy the stock at $48. But remember that the stock is only worth $48 per share in the open market. So this investor would choose not to exercise the option. And if the situation persisted through the expiration date, this option would expire unexercised. So it looks, from the example that we're examining here, that the owner of the call option wants the stock to rise above the strike price. Now, that would be a beneficial situation for them. Now, whereas if the stock falls below the strike price, then the option really doesn't do them much good. It's not going to help them out. Now, we have some terminology to describe this particular situation, this relationship. If the market value of the stock is greater than the call option strike price, we would say that the call option is in the money, which means that it might make sense for the call owner to exercise their call option at that point. Notice that they don't have to exercise when the stock price is at 54. They can wait and hope that the stock rises even higher. But it might make sense for them to exercise here. On the other hand, when we say that the stock was at 48, where the market value was less than the strike price, the call owner would not exercise the option and eventually allow the option to expire. So we would say that if the market value is anywhere down here, below the strike price, then the call option is said to be out of the money in that particular situation. Now, so far we've considered only the viewpoint of the call owner. What about the person who wrote the January 50 call? Remember that for every call owner, there has to be a call writer. Now, this person has an obligation to sell stock under the contract if the stock is demanded of them. Now, when would that happen? Well, let's suppose that XYZ rises to $54 per share. Now remember, somebody else owns the call that this writer created and sold. Would the call be exercised in this situation? Well, remember that the call owner is likely to exercise the option in this case. The owner would demand the stock from the writer who has an obligation to provide it. So we would call this an assignment. The call writer is assigned an exercise notice, so they must sell the stock at 50. So the person who is the call writer now must go out and acquire 100 shares of XYZ stock. Now this brings up a point to keep in mind here. We're assuming in our example that when the writer takes on the obligation to sell stock at 50 on demand, that the writer in fact does not have the stock at that time. That isn't required of you. You don't have to have it in your pocket. So we would have to, if the note came in saying, "Where is your stock?" we would have to go out and buy the stock in the open market for whatever it would take. That situation is referred to as an uncovered option. So we're going to assume that the writer here is uncovered. So in this situation, notice that we would have to go out and buy stock at $54 and then turn right around and sell it to someone else at $50. So obviously this would not be to the advantage of the call writer. The call owner, on the other hand, likes this situation. Now, what if, on the other hand, the XYZ stock declined to $48 per share? Well, in that situation, the call owner is unlikely to exercise the option, so the call would not be exercised. Eventually, it would expire, and the call writer would not have to go through with the transaction. Therefore, if you write a call option, when are you likely to receive an assignment? That is, to have to go through with your obligation. Again, it's when the stock rises above the strike price of the option. As long as the stock is anywhere up here, then you might get an exercise notice. Then again, we would say the call option is in the money. If the stock price falls down below the strike price, the owner will not exercise the option. The writer will not receive an assignment, and again, the option will expire out of the money in that particular situation. Notice that the call buyer and the call writer are both using these terms in the same way. Each would say that the call is in the money when the market value is greater than the strike price. Now, one way to remember this is to think about the phrase call up. If you think about call up, if the stock price is up above the strike price, then the call is in the money. On the other hand, if the market value of the stock is less than the strike price of the call, the option is out of the money in that situation. Now, determining whether options are in or out of the money is a very important skill for you to have. So let's look at some examples to review these ideas. We'll start with an investor who bought an XYZ November 40 call when the stock was worth $42 per share. Is the option in or out of the money? What do you think? Well, first note that this is a call option, so we think call up. Is the stock above the strike price? Well, the market value is 42, while the strike price is 40. And since the stock price is above the strike price, the call is in the money. Let's do a second example. The investor has sold an ABC March 160 call when the market value is 171. Again, we note that this is a call option, and think call up. The market price of 171 is above the exercise price of 160, so the call is in the money. Let's do one more. An investor writes a PDQ August 70 call when PDQ is worth 64 in the open market. And once again, we have a call contract, so call up is the rule. But in this case, the market value of 64 is not above the strike price of 70. So the call is out of the money, not in the money. Note that we did not consider in looking at these problems whether an investor was a buyer or a seller when applying the rules as to whether a call option was in or out of the money. All that mattered was that it was a call option and whether the market value was above or below the strike price. Now, you didn't have to worry about whether the investor was a buyer or a seller in that particular problem. So it's important to note that don't get confused as to whether someone is a buyer or a seller when trying to determine whether a call option is in or out of the money. Just think call up. Is the market value above or below the strike price of the option? Now, if we think about what we've examined so far, it would seem we have a little problem here when we think about the situation that the writer of the call option is in. We're going to try to figure out what's the motivation for doing this, because so far we figured out is that if you write a call option and take on the obligation to sell stock at some fixed price, let's say $50 per share, the only time you'll have to go through with that obligation is if the stock in fact rises above the strike price. So you would have to buy the stock at this higher price in the market and sell it at this fixed lower price, the strike price. Now remember that if the stock in fact fell below the strike price, nothing would happen. You wouldn't have to go through with the exercise. You wouldn't be selling stock. So why would the writer of the call take on this obligation to sell stock when they'll only have to do that when the conditions are to their disadvantage? Well, there is an incentive that we should look at. And in return for providing to the buyer the right to buy stock, the owner of the call then receives that right, and presuming the obligation to sell, the writer receives a one-time upfront payment, which we'll call the premium. The call writer can keep the premium regardless of what happens to the option later on. Now, before discussing this premium in more detail, we should describe how these dollar amounts, these premiums, are quoted in the market so that we can understand them. For example, we might see an XYZ November 40 call at 5. The premium for this option then, we might say, is 5 points. Well, what does that mean? Well, it means that for each of the 100 underlying shares, the buyer will pay $5 to the writer. So our total premium would be $500 in this case. Now, premiums can also be quoted with fractional amounts. Suppose an ABC March 160 call has a premium of $14.50. What would that premium be? Well, to find out, multiply $14.50 per share times the 100 underlying shares for a total premium of $1,450. Now we have seen that premiums can be quoted in fractional amounts. And a common issue with fractional amounts in the securities industry is what's the minimum change in fraction amounts? So if I had $14.50 as a premium, what would be the next biggest premium that I would be allowed to quote, to buy, or to sell at? And it would be $14.51. In other words, usually you can change premiums on options by increments of as little as 1 cent. But usually we will be looking at changes of a few cents up to changes of dollars and cents. Now that we know how to quote a premium, a critical question is how do we determine how big that premium should be? What should the writer receive from the owner of the option in return for providing the right to buy or sell to the owner of the option? So we need to figure that out. What is an appropriate size premium? Well, a good thing to do in this case is to consider that a premium can really be viewed as compensation to the writer of the option for the risk that they're taking. And remember, if we think back to the writer of the call, they're taking a risk that if the stock goes up, they'll have a loss, that they'll have to acquire the stock at a higher price in the market. So the premium compensates them for the risk that they might be taking in assuming this obligation. So let's take a look at an example and see how we might work through what the premium should be. Suppose an investor writes an uncovered XYZ January 50 call. Now remember what that means. They have an obligation to sell stock at 50 if they receive an exercise notice, an assignment. At the time the investor writes the call, let's assume that the XYZ stock is selling for $54 per share in the open market. And notice that the investor has agreed to sell XYZ stock at $50, the strike price. But the stock is already trading for $54 in the open market. So if an assignment occurred right away, you'd have to buy stock at $54 and turn right around and sell it at the lower price of $50, losing 4 points per share on 100 shares. So the writer is immediately subject to a potential loss of 4 points, or $400. This immediate risk to the writer is called the intrinsic value of the option. It is exactly equal to the amount that the option is in the money. Now, if we look at the situation, if you're taking this immediate risk that an exercise might occur, it wouldn't make any sense for you to agree to take on this obligation to sell at 50 when the stock is at 54 unless the premium to be paid to you was at least 4 points in this situation. Otherwise, you're going to wind up with almost an immediate loss on this transaction. So at least 4 points of premium would offset the potential loss that you might have immediately on the option. So let's look at another situation. Suppose we took the same investor, the writer of the January 50 call, and assume that the stock is at $48 per share, lower than the strike price. Is there an immediate risk that the option might be exercised? Well, no, not in this case. Remember that the owner of the call is not going to exercise it if the call is out of the money, which it is here. So it wouldn't make any sense for the owner to exercise it. So there is no immediate risk to the writer. We would then say that the option has no intrinsic value, that it is zero intrinsic value. So it looks like an option does have intrinsic value when the option is in the money. In the call option case that we're looking at here, that would be when the stock price rises above the strike price. On the other hand, if the stock price falls below the strike price, then the option would be out of the money and it would have no intrinsic value. Now, we would expect that the writer would demand a premium that is at least as big as the intrinsic value of the option. But is that all that we should demand? Just the intrinsic value? Well, consider the following problem. We again assume the investor has written a January 50 call when the stock price is at 54. Again, they're assuming the obligation to sell stock at 50. The stock is already worth 54 in the open market, so the option should have 4 points of intrinsic value as we mentioned in our previous example. Should the investor be satisfied with a 4-point premium, or is there an additional risk that should be reflected in the premium? Well, if it's true that the writer is subject to a 4-point risk at the present moment, the writer will continue to be subject to assignment through January expiration. And what would happen if the market value rose even higher between now and expiration? The writer would be subject to even more risk. So this extra future risk is called time value. The writer must try to estimate what this extra risk might be. The writer would consider things like the amount of time left till expiration, the volatility of the stock. Now, let's assume that the writer estimates that this additional risk is 3 points. Again, here we're just estimating that for our example. So the writer should therefore demand a total premium of 7 points, or $700. This would consist of 4 points of intrinsic value and 3 points of time value for the 2 types of risk. So the premium for an option would always consist of those 2 parts, intrinsic value plus time value. Now, a variation of this formula that is often more useful is premium minus the intrinsic value equals the time value. Now, the intrinsic value can be determined mechanically. That is, all we have to do is to look at the option, look at the situation, and figure out if this option is in the money. If it is in the money, the amount is the intrinsic value. That's all there is to it. But the time value is a little bit more complicated to deal with. The market, in fact, would tell us what the time value of the option should be. You may have to, in fact, figure out those 2 components of an option premium. How much is intrinsic value? How much is time value? So let's look at some examples of these types of problems. In this example, the investor buys a February 60 call at a 5-point premium. The market value at that time is 61. And notice that they give us the premium directly in the problem. It's given as 5 points. Now, next, we want to find the intrinsic value of the option. Now, this is the amount that the option is in the money. We note that this is a call option. Now, remember how to figure out whether a call is in the money? You think call up. The stock price is 61, which is above the strike price of 60. So this call is in the money by 1 point, which is its intrinsic value. And finally, the time value is determined by taking the premium and subtracting the intrinsic value. 5 minus 1 gives us a time value of 4 points in this particular situation. So the procedure that we use when we're breaking down a premium into these parts is first, find the intrinsic value, which you can do if you know the type of option, the market value, and the strike price. And then once you know the intrinsic value, subtract that from the total premium and whatever is left over must be the time value. Now, since these concepts are used frequently, let's do one more example in this case. In this situation, we're selling an ABC August 90 call at 6. The market value is 88. Now, first of all, we have to find the amount that the option is in the money. That would be the intrinsic value. Again, since it is a call option, think call up. Is the stock price above the strike price? Well, not in this case, since the stock is only at 88 and the strike price is 90. Since the option is out of the money, what is the intrinsic value? Well, the intrinsic value is 0. And once we have determined the intrinsic value, we subtract it from the premium to find the time value. So 6 minus 0 would give us a time value of 6. Now we've been looking at the premium. Of course, this is the amount that the buyer of the call pays to the writer of the call to offset the risk that the writer is taking that they might suffer a loss on the exercise of a call if that occurs later on. Again, this is what the writer and the buyer estimate is a reasonable compensation for that risk. But remember that we do that at one point in time, whereas the exercise of that option might happen sometime later. And who knows what the market values of the stock would be at that particular time. So the question is, if we know what the premium is up front, the compensation for risk, did that actually turn out to be enough compensation for the writer? It turns out in some cases it will be, but in some cases it won't. So let's pick up the story of the investor who has sold the XYZ January 50 call at 7. Now remember what that means. The writer has an obligation to sell the stock at 50 if assigned, and by accepting this 7-point premium, remember that is supposed to be the compensation to the writer for potential risk, the seller is saying that the stock will probably not rise more than 7 points above the strike price. So we've got the strike price here right now. We get 7-point premium. We don't think that the stock will go much beyond that $50 strike price. So the premium will shield the investor from up to $700 worth of losses. For example, suppose that as of the expiration date, the market value of the stock is at 55. The writer would probably receive an assignment. This would require the writer to purchase the stock in the open market at 55 and then sell it to the owner of the call for 50. The result is a $500 loss for the investor. Or is it? And remember that the writer received a $700 premium up front and therefore actually makes $200 overall. So the $700 premium that they received offset the later loss of $500 and then some. But suppose the stock goes to 62 instead. Then upon exercise, the writer will have to go buy the stock at 62, a much higher price, turn around and sell it at 50, and then lose this entire difference of 12 points per share or $1,200. And notice if that occurs, this 7 points that we received up front for the premium no longer covers our loss later on. We actually do have an overall loss. Now from this, we can see that if the stock price is more than 7 points above 50, any place above this zone that we've marked up here, the writer will have an overall loss. The opposite of that transaction is that the owner will profit. On the other hand, if the stock falls below this critical level, then the owner will lose and the writer will profit because the writer will make more money on the premium up front than they lost on the eventual exercise of the option. So again, if the stock does not go up by more than 7 points, then the writer is in a good position. So it's important to note that the critical value in this situation is not necessarily the strike price of 50. The critical question is, how big was the premium? And then, what is that premium in relation to the strike price of the option? So it's possible in that situation for the investor to make money even though the option contract would be exercised. Now that critical point that we'll be looking at, those 7 points beyond 50, we call that the break-even point. So notice for call options, the break-even point is the exercise price plus the premium, and again, another thing that we can do to remember is to think call up. If I take the strike price and add, I go up by the amount of the premium. Now, we've discovered many of the properties of call options. We begin to create a diagram that is designed to help you remember many of the basic properties that call options have. And one of the things you should be able to do is to construct this diagram from memory so that when you go into the Series 7 exam, you are able to write down these critical clues. Now, when you put this diagram together, let's just see how the basic diagram is constructed. It's going to be divided into 4 quadrants. So you've got one line across the middle, and one vertical line here. So you've got 4 different points. And notice conveniently that that corresponds to the fact that options investors could find themselves in 4 basic situations. You could be the buyer of the call or the seller of the call, or the buyer of the put or the seller of the put. So those are the 4 basic cases. Now, how do you remember where to put these entries? We'll go back to our basic ideas, but remember, it's going to be call up. So calls are going to be above the line, and puts are going to be below the line. So on the left, you have buyers, and on the right, we have the sellers. So that's why this quadrant would correspond to a person who buys a call, the long call. Now, this quadrant corresponds again to a call, but the seller of the call is you're going to have an SC for a short call. Now, long put down here, and the short put over here. And once you've constructed the basic diagram and have entries in the proper spot, you can then start adding these key features that we'll be describing for options investors. And one of the critical things that you want to remember about any option position is the question of, if I'm in this position, what direction do I want to see the market value of the stock moving, up or down? So what you look at, of course, is that the person who buys a call generally wants to see the stock rising. That's the direction in which you'll make money. Whereas the person who sells a call does not want to see the stock go up. They want to see the stock drop. Well, above or below what? Well, remember, that's the break-even point. That's the critical dividing line between making money and losing money for an options investor. So we'll summarize that in the diagram too. The break-even point is the strike price plus the premium. And notice that overlaps both of these quadrants because the break-even point is the same for the buyer of the call and the seller of the call. The difference between the two is which side of the break-even point would you like to be on? If you buy a call, then you want to be above the break-even point. That is, you want the stock to go higher. Whereas if you sell a call, you would like to see the stock go below the break-even point. Now, another critical issue with options, and this is very critical if you're dealing with investors who are considering these options, is how much money can you make and how much money can you lose in dealing with the options. And we'll describe those with the 2 words, risk and reward. And when you see risk and reward, we're thinking the maximum risk and the maximum reward that might be encountered when dealing with a particular position. So, first of all, let's take the person who buys a call. Now remember, if you buy a call, you pay a premium. What's the worst that could happen? Well, remember that you can choose to exercise or not exercise. So the worst that could happen is that you choose not to exercise and you allow your option to expire. In that case, you would simply be at the premium that you paid up front for the option in the first place. On the other hand, how much money can you make? Well, as long as the stock goes above the break-even point, the higher it goes, the more money you would make as the owner of the call. And so we would say that your reward is theoretically unlimited, that there is no maximum amount. Now, what about the person who is on the opposite side of this transaction? Now, that's the seller of the call. Remember that they receive a premium up front. So what's the best that can happen for them? The best that could happen would be that the option would expire and therefore they're not required to do anything. They don't have to go through the transaction. And yet, they still get to keep the premium up front. So that, in fact, would be their maximum reward. They would get to earn the premium. On the other hand, here's our real problem. What happens if the stock doesn't cooperate? Remember that the seller of the stock wants it to go down. But what if instead the stock rises? And remember, the higher the stock goes, the more money you have to pay to buy the stock and then turn around and sell it at the fixed rate price. The higher the stock goes, the more money you lose. And who knows how high the stock would go. So in theory, the risk is unlimited. Now, this particular feature should be a real red flag. It tells us that we need to be very careful about involving investors in this position because there is no real limit to the amount of money that they could lose if things go wrong with this particular option transaction. Now, in addition to a diagram, let's summarize some of the basic features that you've seen so far about call options. Here's a list of some concepts that you should associate with call buyers. A call buyer has, first of all, the right to buy the underlying stock at the strike price. And you really need to be able to remember that phrase as soon as you see someone who is a call buyer. You can always go back to that basic definition to help you understand what is going on. The second feature of a call buyer, they're the one that had to pay the premium in order to acquire the call option, and in fact, that premium would be their maximum possible loss. They hope that the stock will rise. The higher it goes, the more money that they'll make. So their potential gain is virtually unlimited. Now, when you encounter a problem about a call writer, remember the following. Remember, this is the person who has the obligation to sell the underlying stock. Again, this is a real basic idea. As soon as you see call writers, you need to think obligation to sell. You need to automatically associate those terms. Also, if you write a call, you receive a premium. That's why you did it. You receive that money up front. Now that would be your maximum gain. You're attempting to generate some income by earning that premium, by taking on this obligation. Now, of course, you hope that you'll never have to go through with the obligation. You hope that the stock price does not rise, because if it does, that is your real problem. Your risk potential is virtually unlimited. There is no ceiling on the loss that you might suffer. Now, we've reviewed the basics of call options and include that in our diagram, but now we need to turn our attention to put options. Like call options, each put option involves two investors. So here we have an XYZ January 60 put. Now remember that there is an owner of this put option, and then we'll see that someone is the owner of a put option. We need to think that this person who has the right to sell the underlying stock. So owner of the put, right to sell, is the association that we would make. In this case, the person who is the owner has the right to sell 100 shares of XYZ stock at $60 per share until the January expiration. There also must be a writer of the put, though. So remember, for every person who is an owner, there has to be a person who is the writer. Without two people, you don't have an option contract. In this case, the writer of the put is the person who has the obligation to buy the stock of 100 XYZ at $60 per share until the January expiration if they get an assignment. Now, to understand puts in more detail, let's consider the viewpoint of the person who is the put owner. In this particular case, let's see what comes out. Remember that this person has the right to sell the stock at 60. That's what their contract allows. Suppose the stock falls to 55 in the open market. Okay, so you would go, for example, to the New York Stock Exchange and buy the stock for 55 if you wish to do so. What this investor, in fact, could do is buy the stock in the open market for $55 per share, then using the put option, force the writer to buy it for $60 per share. So notice that we're going to earn a profit. The difference between the price we buy it for in the open market and the price we sell it to the writer for under the put option contract. In fact, the farther the stock drops, the greater the opportunity for the put owner to buy the stock cheaply and sell it for the strike price. On the other hand, suppose that the stock were to rise to 63. Now remember, you have the right to sell it using your contract. So for 60, but in the open market, you could sell it for 63. So it would make no sense for you to use your put option in this situation. To sell stock at 60 when elsewhere you can sell it for 63. It would also make no sense to go to the marketplace and buy the stock at 63, only to turn around and force the put writer to buy it at the contract price of 60. So this investor will not exercise the option. And again, if this continues through expiration, the option will expire worthless. So it would seem in this situation, using this example and seeing what would happen, the put owner actually wants the stock to fall. In that situation, they'd be able to buy the stock cheaply in the open market and yet force someone to buy it at a higher price because they have that right with their put option. On the other hand, if the stock goes up, then their option really isn't worth anything. It doesn't really do anything for them in the market. So again, we want to be able to describe these options very carefully. We would say that put options, when the market is less than the exercise price, are in the money. Again, in the money is when we might see an exercise. We don't have to, but we can, and it would make sense for us to think about doing that. On the other hand, if the stock rises so that the market value is up here above the strike price of the option, it wouldn't make any sense for us to exercise our put option. If that continued, we would just allow the option to expire. So we would say that the option is out of the money. It really wouldn't be worth our while to exercise it in this situation. Now, so far, we have considered the viewpoint of the put owner. The writer of this put has an obligation to buy the stock. So we need to think about their viewpoint as well. So they have the obligation to buy stock at 60 if they're required. It won't be their choice as to when this will happen, but they could be forced to buy stock at $60 per share. Now, what would happen to this writer if the stock fell to 55? Remember what happened to the owner? The owner said, yes, I do want to exercise in this situation. So the writer will be assigned an exercise notice, and they'll be forced to buy stock for 60. Notice that the stock is really only worth 55. So the lower the stock goes, the greater the chance that the writer will have to pay too much for the stock. On the other hand, let's say that the stock rises to 63. And remember that the owner of the option in this case didn't exercise the option, and so the writer will not receive an assignment in this situation. If the condition continues through expiration, the option will expire unexercised. The put writer will not have to go through with their side of the deal. So when is there a chance that the writer will receive an assignment? Well, again, notice that when the market value of a stock falls below the price of the put, that's when there might be an assignment. The put would be in the money. Anytime the stock is below this strike price, we might get it exercised. Whereas if the stock goes above the strike price, the put writer will not receive an assignment and the put will expire out of the money in that situation. Now, please remember this rule. Think put down. A put is in the money when the stock price goes down below the strike price. So when we're down, then we have an in the money put. A put is out of the money when the market value of the stock is above the exercise price of the put. Now, let's apply these concepts to some examples because, again, there are very important ones. In the first case, an investor is buying a November 40 put when the market value is 42. First, since this is a put, we think put down. Is the market value of the stock down below the strike price of the put? Not in this case, since the market value is 42, but the strike price is only 40. So this put is not in the money. It's out of the money. In the next example, the investor is selling a 70 put when the stock price is at 64. Do we have put down? Yes, because the stock price of 64 is below the strike price of 70. This put option is in the money. One more. An investor buys a March 160 put when the stock is at 171. Now, think about what's going on here. Notice that we're dealing with a put, so we think put down. But the market value of the stock here is not below the exercise price of the put option. This put is out of the money, not in the money. Now again, notice that the concept of buying or selling the option wasn't really relevant to solving these problems. All you had to know was, is it a put option, and was the market value above or below the strike price of the put? And if we remember put down, that tells us when the put is in the money. When the stock is down below the strike price of the option. Now when we go through these routine examples, it may seem like a simple skill. But when you're in the middle of a difficult problem, you need to be able to go back to these basic skills and make them almost second nature so that you don't even have to think about it twice. You automatically know when a put is in or out of the money. The same goes for calls. And believe me, if you know these skills and you have them down well, it can make dealing with these option problems much, much easier. Now, in the situations that we've been looking at, we again need to think about a problem. We've been thinking about this in and out of the money case. We again have a problem for the put writer. Now, the put writer is going to get an assignment only when the stock falls below the strike price of the option. So they'll be forced to buy stock at the high price only when it really is worth this much. They'll be buying stock that really isn't worth what it is in the open market. They'll be paying too much for the stock. On the other hand, if the stock goes above the strike price of the put, then the writer of the put is not going to be assigned and is not going to be forced to buy the stock. So again, the only time that the writer has to go through with the assignment, with the exchange of money and securities, is when it's to the writer's disadvantage. Why would I take on an obligation to buy stock at a fixed price when in fact that it will only happen when it looks, or at least on paper, that I would take a loss? So again, there has to be some incentive for the put writer to give to the put owner the right to deliver the stock. So again, for providing the put owner with that right, the put owner must pay to the put writer a premium. And it is that fee, that incentive of getting that upfront premium, that would cause the writer of the put to consider taking the chance that writers do take. Now remember that the writer keeps the premium no matter what else happens in the contract. That upfront premium is theirs to keep. Now, like call premiums, we can look at put premiums as compensation. If you're taking a chance, taking a risk as a writer, you're getting paid up front. That money is your compensation for the risk that you're taking. So again, we can think of the risk to the put writers in the same way that we looked at and broke down the risk to the call writers. that these premiums, these risk premiums, can be divided into two basic components, which would be the intrinsic value, the immediate risk, and the time value, that future or potential risk that we're not too sure about and have to estimate. So by looking at a problem, dealing with the intrinsic value and time value of a put option, we can review these ideas for put options. Now, first of all, the intrinsic value of a put option, like the intrinsic value of a call option, is the amount that the option is in the money. So again, we can figure out that by the exercise we just went through to determine whether the put option is in the money, we think put down. The stock price of 58 is below the strike price of 60 in this particular case. So the option is in the money by 2 points and has 2 points of intrinsic value. Now, to find the time value, we then do exactly the same thing as we did with the call option. We take the premium and subtract the intrinsic value. We break it down the same way. So 8 minus 2 is a time value of 6. Let's try one more example because this is an important concept. In this particular case, we're selling a 100 put with a 4-point premium and the stock is at 103. The intrinsic value of an option is the amount that is in the money. And since we have a put option here, it is in the money if the market price is less than the strike price. So is that what we have? Well, the market price is 103 and the strike price is 100. So the put is not in the money. It is out of the money. Remember that it is only in the money if we have put down, which we don't have here. Therefore, its intrinsic value is going to be 0. The time value then of this option is the premium minus the intrinsic value. So in this case, the premium is 4 points minus the intrinsic value, which is 0. So in this case, the time value is also 4 points. So what we have again is a case where if the premium is a risk compensation that we pay to the writer for taking a chance, we need to look at what's the relationship between an eventual profit or loss and the premium that you receive, because that is again built into whether there is an overall or eventual loss in that situation. So that risk premium coming into the writer, basically what the writer is saying by accepting this premium is that they're expecting that the eventual put exercise, if it ever occurs, will be less than the premium that they just received, and they'll have a profit in that case. But if it turns out that the option is eventually exercised and they lose more money on the exercise than they received from the upfront premium, then the expectation didn't work out and there is an overall loss in the transaction. And so to see how the premium is related to risk and reward of this investment, we'll examine again an XYZ January 60 put. In this situation again, we have the strike price of 60 and a premium in this case of 8. So again, what is the writer saying by accepting an 8-point premium? They're considering that the stock will fall by 8 points at most. So if the stock falls by less than 8 points, then they're going to be ahead of the game. So the 8-point premium is going to be related to the eventual thought on how far down the stock will go. If the stock falls below 60, they could be forced to buy stock at the strike price of 60. And what they're hoping is that they'll lose less than 8 points in that eventual transaction. So in theory, the premium compensates the writer for up to 8 points of risk, which is the risk that the stock will, in the case of a put, fall by up to 8 points. As long as the stock does not fall by more than 8 points below 60, the writer should be okay. Now, let's take an example and see if that works out. For example, suppose the stock falls to 56. Well, there would be an exercise in that case because remember, that option is in the money. So the owner of the put is going to exercise it. We're going to be forced to buy stock at 60 that's really worth only 56. So at least on paper, we've got this 4-point loss in this situation. But remember, we received an 8-point premium up front. So overall, we're still all right. We still have an overall profit when we look at both transactions. However, what if the stock falls by more than 8 points below 60? The writer is going to have a problem. For example, let's suppose that the stock value falls all the way to 48. In this case, you're going to have to buy stock at 60. Now, if you're the writer of this put, when actually the stock is only worth 48. So at least on paper here, you have a 12-point loss. Notice that exceeds the 8-point premium you received up front. So overall, you're going to have a loss. You're going to be behind the game in this situation. So the critical level in this particular situation is the level that we're looking at right here. It would seem that if the market value of the stock falls below this level, which turns out to be 52, notice it's 8 points below 60, the writer will lose. And the opposite side of the trade is that the buyer will profit. On the other hand, if the value of that stock stays above 52, then the writer will profit and the buyer will lose in that situation. So that level, $52 per share, is a critical one. That is the break-even point for this particular put option. So how do we find that point for a put option? A break-even point for a put option is the strike price minus the premium in the transaction. So that fits into the rule, put down. If we think about going down below the strike price by the rate of the premium to find that break-even point. Now that we've explored some of the basic features of put options, we're ready to summarize these concepts in our option diagram. So remember, our option diagram from a previous discussion. Now, we're going to fill in the entries for the put options that we've been working with. So if I buy a put option and I have the right to sell the stock at a specific price, recall that I actually want to see the stock drop in order to make a profit. The put writer, whose case we just examined, would actually not like to see that. They would have the opposite desire. The put writer would short the put, would like to see the stock go up. Now, the critical level, though, that divides gains from losses is this one. It is the break-even point that we just found. So the person who is the owner of the put, long a put, wants the stock to go below this break-even point. On the other hand, the person who sells that put, short a put, wants the stock to stay above that very same break-even point. And what about risk and reward? How much can you make or lose going through these various types of transactions? Well, again, let's go back to the person who buys the put option first. This person pays the premium to get the privilege of selling the stock at a fixed price. They can either choose to use that privilege or not. It's up to them. If they choose not to use the privilege because it's really not worth it for them to do that, how much do they lose? Well, just the premium that they paid on the option in the first place. On the other hand, they're hoping that the stock will fall below the break-even point. That's the best thing that could happen to this investor. Well, the stock, in fact, not only falls, but also it falls all the way. And what it can do is go down to zero value for the stock. At that point, you'd still be able to take a virtually worthless stock and force somebody else to buy it from you at the strike price. So you would make the strike price. However, remember that you did have to pay the premium up front to buy the option in the first place. So the most that you would be able to make would be that strike price minus the original premium that you paid out. And how about the person who sells the put? Now, before we discuss the individual entries here in any detail, there is one thing that we should point out. Now, remember in our discussion of call options, notice that in that discussion, the risk for someone who buys the call is the reward for the person who sells the call. The reward for the person who buys the call is the risk for the person who sells the call. The person who sells a put will have as a maximum gain what the person who buys the put is risking, which again is the premium. And that makes sense. If you sell a put, you get the premium up front. The best that could happen is that you keep the premium. On the other hand, the worst that could happen is that you could be forced to buy essentially worthless stock for the strike price. So at least on paper, that would be a loss, but you do get to keep the premium that you received up front. So the worst that could happen to you in that situation would be that you'd lose the strike price minus the premium. So by including in our diagram all of these basic ideas and committing that to memory, jotting it down whenever you're trying to work out through some option problems, it can help you check your thinking on the option problems that you're dealing with. Now let's look at the concepts again that we're looking at here. Whenever we see somebody who has purchased a put option, this is what we should think. This person has a right to sell the underlying stock at the strike price. So again, put buyer and right to sell are associations that you should be able to make immediately. Pays the premium. If you bought the option, then you have to pay for it. Well, that turns out to be your maximum loss. On the other hand, you're hoping that the stock will fall, and the best that could happen is that the stock just goes down to zero. At that point, you will earn the strike price minus the premium as your maximum gain. On the other hand, whenever we encounter a put writer, the following idea should come to mind. Remember, the put writer is the person who has the obligation to buy the underlying stock at the strike price. So again, the immediate association here should be, when you see put writer, think obligation to buy. This is the person who receives the premium. That is your compensation for the risk that you're taking, and that premium is the maximum gain that you can earn. You're attempting, in fact, to generate income by earning that premium or writing the option. Now you hope the stock does not fall, but if it does, that's when you have a problem. The stock could fall all the way to zero. You could be forced to buy worthless stock for the strike price. although you do get to keep that premium that you received up front. So the maximum loss that you could have would be the strike price minus the premium. Now, you may find it helpful to commit the option diagram that we've been working on to memory. And that way, when you're working on option problems or studying for the exam, you can check your thinking. Of course, you can't bring anything into the test with you, but you will be allowed to use scratch paper. And when the exam starts, you could write down this diagram as a memory aid after the exam has begun, and then check your thinking about these 4 basic option positions when you encounter problems about options. Now, some of the types of problems that you may have to deal with are going to ask you to determine the eventual outcome of an option transaction. Now, it's important to note that there are only 3 real possible outcomes to an option transaction that an investor is involved in. Number 1, the option could expire. Number 2, the option could be exercised. And number 3, the option could be liquidated or closed out. So we'll go through each of these 3 possibilities and see what the outcomes might be. Now, some of these problems will involve lots of steps and involve tons of information. So one strategy to keep all of the information straight would be to use a diagram that I call a T-chart, or a paid received chart. On the left side of the chart, we would list all of the monies the investor has paid out in the problem, which are debits to their account. On the right side, we enter any money that the investor has received during their transactions, which are credits to their account. And once all the information has been entered, we compare the 2 sides. If the investor paid more than they received in the transactions, of course they have a loss. If they've received more than they've paid out, then they would have a profit from the transaction. On the other hand, if the amount paid out equals the amount received, the investor has broken even and there is no gain or loss. So this chart can help us look at a systematic technique for going through these option problems, and it can prevent you from overlooking or forgetting about a specific part of the problem that occurs on the exam. So we'll take a look at how we might use this chart to help you solve some of the problems that you might encounter as you're going through this material about making money and losing money on these types of transactions. So let's take a look at an example. First, we're going to look at the options expiring. Now, if we look at this problem, you're purchasing a 30 call for 2. And remember, that's $200. The market value of the stock is 31 at the time. The stock drops to 28, and the option expires unexercised. So what's the investor's gain or loss? Now, the key words here are, what is the profit or loss on the transaction? That's the tip-off, when we see those words, profit or loss. Then we should use the T-chart to solve that problem. So we put our paid and received diagram. Next we ask, did the investor pay or receive in this problem? Since the investor bought the call, the premium would be entered in the paid column. It's also helpful to indicate where the entry came from. So this entry, 30C, indicates that we bought a call with a strike price of 30. So later on, if we're doing a complicated calculation, we can remember where the number came from. Now remember that the option expires in our problem, so it's worthless at that point. So the corresponding entry that we'd made would be received in the received column, since the option brought no return to the investor. So the overall result is the investor has a loss of $200. In this case, the amount paid was greater than the amount received, and we did have a loss. Let's do another example. In this particular case, we're going to deal with the seller. Now, this seller sold the put at 13. Okay, there is a $1,300 premium. The stock was at 101 when they did that. The stock remains there through November and the option expires. So what's the investor's profit or loss? Again, the words profit or loss indicate that we should use a paid received chart in order to solve this problem. So we put up a paid received chart. Since this investor sold a put, remember, we're selling, so we receive the premium. So the premium goes on the received or credit side, $1,300 in this case. And of course, this entry just reminds us that we are selling a 100 put. Now, later, the option expires, so that's another key in the problem. Of course, what that means is that the investor no longer has an obligation to buy stock. They will not have to pay out any money. Now, remember, the option's just expiring. Therefore, the investor will earn the $1,300 premium in this particular case. Now, these examples are relatively simple, so you might think, well, why do we need all this technique of using a T-chart? Well, we're going to be looking at some very different problems that are a bit more complicated, in which several things are going on, and it's real helpful for you to have a T-chart because you can track through each transaction that occurs in the problem and then the end result is comparing the total paid to the total received. Now, the second possibility to which we'll apply this technique is the possibility that the option could be exercised. So let's take a look at that particular type of example. In this case, we're buying a call for $400 with a $20 strike price. The stock is at $22.50. Later, the stock rises, and then the investor exercises the call and sells the stock. So notice already that there are a lot of things going on in the problem, and we need to keep track of all of them. The eventual thing that we have to find is clear: the gain or loss. Now, the words, "what is the gain or loss," would lead us to set up this T-chart. So the first transaction is the purchase of the call. So the first thing we do is we buy the call option. So we have to pay the premium, and $400 is entered in the paid column. Again, this entry reminds us that this was for buying a 20 call. Now next, the stock rises to 26, and that right there does not cause us to make an entry. This is just what is happening in the stock market. However, what does the investor do next? Well, the investor exercises the call. Well, what does that mean? Now remember that if you own a call, that means you have the right to buy the stock at the strike price, which in this case is $20 per share. So you are going to be buying some stock, and that of course creates a new entry: 100 shares of EXP for $2,000. So that creates a second entry in our diagram because we do have the stock position at this point. Next, we are told that the investor sells the stock in the market at 26 for $2,600. Now we're done. We've used up the call, we've bought and sold the stock, and now we're ready to total up each side. So we find that the investor has paid out $2,400 and received $2,600 for a profit of $200. So then notice that these more complicated problems have several entries, and it certainly helps to be able to go through systematically and make sure that we've included all the entries that are in the problems so we don't overlook some critical part of the problem. Then we just net out the transactions in the end. Let's try one more example because these can be a little bit more complicated. In this particular case, the stock is selling for $158, and the investor does sell a call at that point for $600. The stock goes up, and the investor is assigned. Now, what's the profit or loss? Again, the words profit or loss imply that we should use a T-chart to help solve the problem. So what's the first thing the investor did? Well, the investor sold a call. That's the first action that they took. Therefore, they will receive a premium. In this particular case, $600 for writing the 160 call. Now later, the problem says that the stock rose and the investor was assigned. Now, what does that mean for this investor to get an assignment? Well, they are the writer of the call. So since they wrote the call, they have an obligation to deliver the stock to the buyer. But notice that we have a problem here. The setup does not tell us that the investor has the stock. We cannot assume that the investor does. So what we're going to have to do is to go out into the open market and obtain the stock at the current market price. And what is it at this time? It's $172. So we're going to have to pay $17,200 to go out and get the stock in the open market. And then what do we have to do? Well, under the terms of the contract, we have to turn right around and sell it to the call owner for $160 per share, because that, of course, is the strike price that we agreed to. The sale will produce cash received in the account of $16,000. So in that situation overall, the investor has paid $17,200 and received only $16,600, so that produces a loss of $600. So when we're doing these transactions that involve some type of an assignment or exercise, we need to remember that one of those transactions is going to occur at the strike price of the option, because the exercise, of course, is based on the strike price that we originally agreed to when we set up the contract. Now, there is a third possible outcome. We've looked at option expiration and option exercises. This third possible outcome is that option that could be liquidated or closed out. And we've not really talked about this before, so we should look at the concept. Now, to explain this concept, what we'll do is to look at a group of investors, all of whom have been involved as buyers or sellers with the same option. They've either all sold or bought a specific option contract. Now, in this case, it's going to be the XYZ January 50 call option. Now, each investor here has set up a relationship with the other investor. For example, buyer number one and seller number one at one time engaged in an option transaction, and the premium changed hands between those two. Buyer number two and seller number two also did the same thing. They exchanged money in an agreement prior to that. So this buyer paid this seller a premium. But notice, though, that the contract is the same. Buyer 3 paid seller 3 a premium, again, to buy this specific contract. But notice, though, that even though we have different transactions done at different times between various buyers and sellers, all of the buyers are really in the same position. They all have the right to buy 100 XYZ at $50 per share until the January expiration. And likewise, all the sellers are in the same boat. They have the obligation to sell XYZ at $50 per share. So in many ways, all the sellers are interchangeable and all of the buyers are interchangeable. So this is going to be a very useful feature to us as we go through this particular problem. Now, what we want to do here is to put ourselves in the shoes of one of these sellers. Now, remember that the sellers have agreed to sell the stock at $50 per share. Now, if you sell a call option, what are you worried about? Well, we're worried about the stock going up in value. So what if the seller, for example, takes a look at the open market and sees the market value of this XYZ stock rising to, say, like $58 a share? Now, they're going to get a little concerned because they did receive a premium up front. And although they know what that is, they also know what they could receive an exercise notice at any time. That would require them, assuming they're uncovered, to buy the stock at 58 and turn right around and sell it at 50. But remember that if you're a seller of an option, you don't control when the exercise occurs. The writers don't control the exercise. It's the owners of the option that control it. And what could happen? Well, you might not get an exercise notice right now. In fact, things could get even worse. For example, what if the market value continued to rise? Let's say it went up to $65 per share, for example. Now, again, you're sitting here with this obligation to sell the stock at 50, and the stock is already up to 65. So anytime you could get a notice saying, you have to give me stock at 50, so you'd have to go out and buy the stock at 65. You have an even bigger loss staring you in the face. So notice that if the stock keeps going up, the sellers ought to be awfully uncomfortable. Their losses keep mounting up, and at least on paper. And there is no way that they can say, well, let's just go through with the exercise and get this over with, and at least I know what my loss would be at that time. They don't have that kind of control. They don't decide when the exercise occurs. Now, there is something else that the writer could do in this situation to try to get out of the dilemma of just having your losses mounting up and mounting up. Remember that we're dealing with a contract here, and there is a buyer and seller, or writer, involved in each of the contracts. And with any contract situation, of course, both parties are bound by the contract unless one party can get the other party to release them from the contract. So it would certainly be nice if seller 1 could get buyer 1 to let him or her out of the contract. But notice that if we can't get buyer 1 to do that, seller 1 could get any of these buyers to release him or her from the contract. If we were able to do that, our obligation would cease at that point. So let's say that seller 1 can get buyer 2 to release them from that particular contract. If buyer 2 would be willing to do that, seller 1's obligation would be canceled out along with buyer 2's right. And both of those players would in effect leave the game. Now notice that we still have 2 buyers and 2 writers, 2 sellers, left in the game at this point. Now remember, we always have to have equal numbers of those parties. Now, why would a buyer allow you to do this? To say, I'll let you out of the game and I'll cancel your obligation, and along with that, my right disappears at the same time. Why would a buyer do that? Of course, there has to be some incentive, and we can imagine that incentive is a payment, a fee, a premium. That's why the buyer would do it for you. The seller pays the buyer a premium to allow the contract to be canceled at that point. Now, we'll see that it may cost you a bit of money to get your obligation canceled at this point, but it may be worthwhile for you to do that. At least you know what your losses are at that particular point, and you're not waiting for the stock to go even higher and cause even greater losses for you. So to do that occasionally, sellers want their obligation canceled. They pay a fee to the buyer or the owner of the option to release them from the contract, and the obligations are then canceled. So that's known as liquidating or closing out an option position. And notice in that situation that if a writer wants out, a buyer has to leave the game as well, so that we always have equal numbers of buyers and sellers left in the game at this particular time. So these pairs of transactions that these options investors engage in would be called opening and closing transactions. So it's important to know how this vocabulary works. For example, an investor who starts by buying an option would be engaging in an opening purchase, which is kind of like an opening move in a game. To liquidate this position, an investor would do a closing sale. So notice that you do the opposite. If I open by buying, I close by selling. Investors who write options, what are they doing? Well, they're doing opening sales. Their opening move is to sell or write an option. So how do they leave the game and cancel their obligation? They would do a closing purchase that cancels out their original sale. Now, in our example, we assume that we found an investor out there who was a buyer already, who owned that option, who would allow us to cancel our contract. So one writer and one owner left the game at the same point. But what if none of those buyers were willing to let you out of the contract? Remember that these buyers are in a good position now. The stock is going up, and their call options are worth a lot of money, so they may not want to let you out of the contract. Well, there is another way for you to get out of the game in this situation. If you could find somebody to act as a substitute for you in the game, think of it that way. So, for example, let's see if we can find another investor to take our place in this situation. Seller 1, for example, might find a substitute seller 4 who is willing to take his or her place in the game. Seller 1 and seller 4 would have to reach an agreement on fair compensation. This would take the form of a premium paid by seller 1 to seller 4. So seller 1 is paying to do a closing purchase, while seller 4 is receiving a premium for doing an opening sale and then joining the game as a seller at that point. So notice again, seller 1 is out of the game, seller 4 has substituted. And we still have equal numbers of buyers and sellers, which we always must have in these types of option transactions. So by closing out the sellers, the writers are relieved by their obligation, and the owners of the obligation have to give up their right if they leave the game as well. You have to make sure, though, that in order to close out your position, you do exactly the opposite transaction from your initial move in the game. So we should take a look at some examples to be sure that we're able to pick out the right closing transaction. The investor buys one ABC May 140 call at 4. To close out this position, what would this investor do? Well, first we need to think. What do they do to begin with? Well, in this case, they were buying a call. So to close out that transaction, remember that they would do the opposite transaction on the same type of option. So in this particular situation, the proper closing transaction would be B, to sell exactly the same call. So notice in this situation, the buy choices are eliminated because you have to sell to close when you buy to open. Whereas in this particular case, we would also eliminate this one because this is for a put option. If you were to close out a call option by selling it, it has to be related to the call option that you bought in the first place. You can't close out a call option by selling a put option. Let's look at one more example. In this particular example, our investor sold 2 XYZ March 40 puts for 6 points each. How could this position be liquidated? Now, think about what that would mean. What is your opening transaction, and then what would the corresponding closing transaction be? In order to liquidate this original position, this investor would do D, buy 2 XYZ March 40 puts. Notice we can eliminate, for example, this one, C, because it's the wrong stock, of course, and since we sold 2 puts to begin with, we have to close 2 puts out in order to cancel our position. And of course, if you start by selling, then you close by buying, so that eliminates this one, B. So D must be the correct answer in this particular case. Now that we've seen how closing out can help a seller because it cancels out their obligation, they were afraid that their losses might keep mounting up, and so by closing out, they have no further obligation. They might have had a loss to do the closeout, but at least their loss is limited and set at a certain amount. What about buyers? Well, buyers often want to close out as well, and why would you want to do that if you were a buyer? If things are going well, if the stocks are going up and it might be profitable for you to exercise, what's in it for the buyer in terms of closing out an option or liquidating a position? So let's take an example. Suppose that the market value of ABC stock is $104 per share. An investor buys a January 100 call at that time for $700. Now, note the investor's break-even point for this is 107, strike price plus premium. Now, suppose that the stock does rise to 128. And notice that's certainly above the break-even, and so this should be a profitable situation for the buyer of this call. How could the buyer of this call take advantage of this situation? Now, we could, of course, exercise our option, but we could also see another possibility at this point, is that we could close out the option by selling an ABC January 100 call for a certain premium. The question, though, is how much would the owner of the call receive for selling the call to close out the position? The investor would receive the current premium of that option. Now, what the option is selling for at that time, at the time of the closeout occurs, and as in any situation, we can figure that out, the option premium should be by thinking what the intrinsic value and time value should be for a premium at that particular point in time. So first, we're going to determine the intrinsic value, as we usually do, and then think about the time value of the option. So the strike price of the option, notice in the example that we're looking at, was 100 per share. The market value of the option at the time we close out is 128. So at the time we close out this premium that we're trying to determine should have intrinsic value of 28 points, since the option is 28 points in the money. So the premium will at least be that large, but we assume that the option is not real close to expiration. Then there will be some time value included in the premium as well. Now, we don't know exactly what it's going to be, but what we're going to do here is to guess or estimate how much time value should be included. So we're going to guess maybe 2 points of time value included and include that in our calculation. So with 28 points of intrinsic value plus another 2 points of time value, that would give us a total premium at that point of 30. So we would be assuming that we are closing out our position at 30 points in this particular point in time. So the question is, if we could either exercise this option when the stock is at 128 or choose this and sell at 30 as a final premium, which one should we do? We have a choice between the two. Now, if we exercise, we will certainly earn a profit. For example, we could exercise at 100 and buy stock for $10,000 on 100 shares, and then we immediately turn around and sell the stock at the current market value of 128. So our total cost was the premium plus the strike price for the call option. Our total proceeds are $12,800. The market value, so we make $2,100 if we exercise the option. Now, another choice to remember is to close out the option. What happens there? We'll buy the option for $700. So how much can we resell it for at that time? We'll assume that the premium was 30. So the option now is worth $3,000, which is what we could sell it for at that particular moment. So not only would we have a profit, but also notice that the profit here would be larger than if we had exercised the option, $2,300 in this particular case. Now, some of the problems on the exam are going to require you to think about what happens when an investor closes out a position. So we should look at some practice examples that take this into account. So let's look at some examples. Now, what they're looking here at is an investor who is selling the call. The company announces improved financial results, and that, as usual, means the stock goes up. So when the stock reaches 40, the investor repurchases the call for $700. What's the profit or loss? Now, again, the key words here are profit or loss. Now, that indicates that we should use a T-chart to solve the problem. First, the investor sells the option, and that means, of course, that they're going to receive the premium of $300. If you sell an option, you receive a premium. And, of course, we remind ourselves that that was for selling a 35 call. Next, though, the investor does a closing purchase for $700. Notice that if you do an opening sale and receive money, you do a closing purchase to close out or cancel your position. But we had to pay $700 to do that. Now, notice that all the other information in the problem is extraneous. You opened a position by selling, you close a position by buying back. Your position is gone and you're all ready to calculate your gain or loss. So the net result is a $400 loss in this situation. Now, in some of these problems, the information is going to be given to you indirectly. You may have to dig it out. So, for example, we have in this case an investor who buys a put for $600. Later, the stock rises, and just before expiration, the investor liquidates it and closes out their position at intrinsic value. What is the gain or loss? Again, we start by pulling up the T-chart because it's a gain or loss problem. And notice, what did the investor start by doing? Well, they started by buying a put and paying the premium of $600 in this particular case, and notice that was for the 35 put. Later, the investor liquidates the position, so what happens? How do we liquidate this position? Well, we open by buying, so the closing transaction would be a sale and would be entered over here, but they don't tell us what that closing premium is directly. All we know is that the investor closed out just before expiration. Those are the key words in the problem. Now, what information can that give us? When we close out just before expiration, what's the premium going to be? Remember that a premium consists of two parts, time value and intrinsic value. But just before expiration, there is no time left. The option is about to expire. So when you see this type of language, you assume that there is no time value because we're just prior to the expiration date. So the premium and the intrinsic value will be the same in this situation. So since the option is a put, then of course what we would do is to calculate the intrinsic value by figuring out whether it is in or out of the money. So in this situation, the stock price when the investor liquidates is $34.50. The strike price is $35. And we think again, put down. Yes, this put is in the money by half a point. So that's again half a point, 50 cents per share times 100 shares. The intrinsic value then is $50. So we're closing out at $50 in that situation. So the net result is a loss of $550. Now, closeouts occur fairly frequently. If we look at the three possibilities, the investor could exercise the option, it could expire, or we could close it out. Now, very few are actually exercised because it turns out that the transaction costs that are involved, the inconvenience of dealing with the stock and the ease of closing out make that a more attractive alternative to exercising an option. Now, so far, we have examined the use of options as basically speculative investments. For example, if you believe that a stock was going up in value, well, think about your diagram. With stocks going up, that means that I could buy a call or sell a put. On the other hand, if I thought that the stock might go down, I could buy a put or sell a call to speculate on whether that was going to occur or not. But options can be used for other things as well. For example, an option could be used as a defensive investment. So let's take a look at an example where the other use for an option might occur. Now, here we have an investor who believes that stock is selling at an attractive price right now, but is concerned that the market might fall once the stock is purchased. So if the investor buys the stock, what option positions would provide downside protection? So notice that the investor's motivation for looking at options in this case is as protection. Now, this is a little bit different motivation than we've seen before. So the use of options as protection is called hedging. In this case, we're trying to protect the long stock investment, that is, stock that we already own. Now, this would be a long hedge, protecting a long stock. Now, our main investment is the stock that we own. If the market value of the stock rises, then we should have a profit on our stock position. But what if the stock falls? Well, if the stock falls, then we could have a substantial loss. Remember that in our example, we had $8,100 tied up in our stock? In order to limit the possible loss, we also have a secondary investment, our hedge. And what happens is that this must be an investment that will produce a profit in case the main investment begins to lose money. So what we're hoping is that the profit on our secondary investment will offset at least some of the loss that we have on our main investment. Hence the idea of hedging. Now, if an investor is trying to protect a long stock position, we need to figure out what kinds of positions will provide protection to our hedge. For that, our basic option diagram can help us. Let's think about how we can use it. We're concerned that if we buy stock, the stock that we own might fall in value. We would like to have an option position as a hedge that would be profitable if our stock falls in value. Well, in fact, that's what the arrows on our basic diagram tell us. What option positions would be profitable if the stock falls? Well, notice, according to our arrows, that it would be the long put and the short call that we would be looking for. Now, it turns out that although both of these could be useful as a hedge, one is better than the other. The long put will provide better protection than the short call because remember that you own the long put. You decide when to exercise the option, if ever. With a short call, you simply have an obligation to do something. And although you receive the premium, you don't control the exercise of the option. So we're going to look at an example where we're going to use a long put option to protect a long stock position. In our situation, the investor has long 100 shares of XYZ at 81. Now, when we say long stock, what we're saying is that this investor owns the stock. So they have invested $8,100 in this position at this point. As a hedge, we're going to buy an XYZ January 80 put for $600. Now, to see what's happening with this position, it can be helpful to set up a T-chart because that explains everything that's going on. Now, we're starting by entering the $8,100 that the investor has spent on the stock, and we indicate, of course, that that's associated with the stock position. We also enter on the paid side the premium of $600. Now, remember that we did have to pay for the put, and therefore the premium is the cost for the 80 put. Now, how does that put act as a hedge in this situation? Well, let's look at the example. Suppose that this stock, which we originally bought at 81, suppose that it fell to, say, $45 per share. Now, if you didn't have this hedge, obviously you're looking at a very large potential loss in your position. But in this case, remember we have an 80 put. What is that? Well, that's the right to sell the stock at $80 per share. That's the strike price. So no matter what the stock is actually worth in the open market, this means that the investor will never receive less than $8,000, the strike price for the stock, as long as we have that put option for protection. So the worst that could happen to this investor would be that they would have paid out $8,700, $8,100 for the stock, and $600 for the option, and receive $8,000 overall. So they would have a loss, but that's the maximum possible loss of $700. So the put option, we can see, acts as a safety net. If the stock starts to fall, we don't have to worry about it too much. We might have some loss, but we won't have an enormous loss because we can always take that stock and force someone else to buy it at the strike price. That strike price gives us a level of comfort. That's the protection we get. In fact, we can think of it as an insurance policy. If you have a major disaster on your stock position, the put option is the insurance policy that is there to protect you against having too large of a loss. Now, here again is what our position looks like when we have set up our hedge. We want to look at some other things about this position, though. Now, we have to hope to make money, of course, as the stock goes up, but how high must the stock rise before we have a profit? We looked at what happened when the stock went down. Well, since we've paid out a total of $8,700 so far for these two parts of the position, we must receive at least $8,700 just to break even. Above $8,700, we'll make a profit because we will have gained more on the stock position than we originally had invested for the total. So there is no ceiling on the possible amount of profit that we can make on this position. $8,700 is significant because that turns out to be the break-even point. If the stock is at 87, it's worth at least the total amount of money that you paid for both positions. So in general, to find the break-even point on a hedge position, we think, how do we make the amount paid equal to the amount received? And so by finding in our diagram that corresponded to 8,700, or a stock price of $87, we could determine that the break-even point would be for that position. Now, there are other ways to use options as hedges besides that example that we looked at here. For instance, let's take a look at this case. Now, here an investor believes that ABC is overvalued and has sold short 100 shares of stock. Now, briefly, remember what that means. This investor has borrowed 100 shares of stock, hoping that the stock will fall and produce a profit for the investor when the stock drops. But takeover rumors have been circulating about ABC, and so the stock could rise. Now, that is when a short seller is going to have some trouble. They could have large losses as the stock goes up. So what option position would protect an investor against a rise in the price of ABC stock? Now again, notice in this case, we want protection against a rise in the price of the stock because we're trying to hedge a short position. In a short stock position, the investor is hoping that the stock will fall. If the stock falls, since the investor has sold borrowed stock, the stock falls and the investor makes a profit. So as the stock drops, this would result in a profit to the investor. However, the danger is if the stock rises. If the stock does rise, then the investor will have to pay more, sometimes much more, for the borrowed stock to replace it than was originally received. So this can result in a large loss to the short seller. Theoretically, it's unlimited. So this seems like a good time to use a hedge. Now, what we need, though, is an option position that would be profitable if the stock rises. So we hope that the profit we earn on the hedge will offset some of the loss we have on the short stock position if the stock goes up. So how do we find out what to use here as a hedge? Now, recall that in our option diagram, the two positions that might work that would produce a profit as the stock goes up would be a long call and a short put. So there are two possibilities that we could use here. But again, one of them works better for us, has more flexibility, and that is the long call. Remember that with a long call, you own the option and you decide when to use the option. So you have more control in this situation, and it will work better for us as a hedge. So we're going to take a look at an example here of what to do. Now, to see how a long call could act as a hedge, let's take the short stock position that we have here in our example. We shorted the stock at 113, and the investor, after doing that, looks for protection against rising stock prices by buying an ABC February 115 call at 8. We'll assume that this is the position that they'd want. now a paid and received diagram, again, can be real helpful because it can help us visualize what's going on. Notice our first entry for this short sale will be on the received side because when you short stock, you borrow stock and sell the borrowed stock. So since the investor is selling the borrowed stock, then that entry would go on the received side. $11,300 was going to be sold as stock at $113. Now we've also purchased the call, but since we bought the call, that premium is entered on the paid side of that diagram. Now, that's a cost to us. The critical question for the short seller is, how much will we have to pay to replace the stock that we borrowed? Because you'll have to do that at some point. You borrowed stock and sold it, and now you're going to have to give it back. You're going to have to buy it back to give it back. What are you going to have to pay eventually? Now, of course, the danger to the short seller is rising stock prices. For example, suppose that the stock rose to $150 per share. We would have a real problem then if we just had a plain short sale. We'd have to replace the stock at $150, but you'd only sold it for $113. So a large loss would be incurred. But the investor, remember, owns a call. What is that? It represents the right to buy stock at $115 per share, the strike price, on demand. So the short seller will never have to pay more than $11,500 to replace the stock. So at worst, the investor will pay $12,300, $11,500 for the stock plus $800 for the option, against $11,300 received. So the maximum possible loss would be $1,000. Now, that may seem like a large amount, but look at what you could have as a loss. In this case, we have $3,700 potential loss, and there is no limit to what it could be. So if this is your maximum loss, at least you put a ceiling on how bad things could get. Of course, this investor hopes to make money as the stock falls. What would be the best possible outcome for the short seller? Well, the stock goes to zero. Now, that's what the investor is hoping for. If the stock goes to zero, then the investor would pay virtually nothing to replace the borrowed shares. However, the call option, like an unused insurance policy, expires worthless. And you can see that because the stock is at zero and the call is at $115, so it's way out of the money and therefore worthless. So what we would have is that the investor would pay $800 for the option, and if the stock goes to zero, they would receive $11,300 from the short stock position for an overall net profit of $10,500. That's your best possible outcome in this scenario. Now, another question that you might be asked about this particular position is, what is the break-even point? Now, we know that on a short sale, the investor wants the stock to fall. Ordinarily, this investor would make money if the stock fell below $113 because that's the price that the original short sale occurred. But remember that this investor also paid $800 for the call. That's the insurance policy cost, and we need to recover that cost. Therefore, the investor must make $800 on the short sale just to offset the cost of the call. So the stock would have to fall to $105 for the investor to break even. Now, to show that $105 is the break even, assume that the stock goes to $105 and we close out our short sale at that time. Now, what would the T-chart show if we chose to do this? Well, we'd replace the borrowed stock by buying it back for $105 per share in the market, $10,500. The call would be out of the money and it would expire worthless. Remember that the stock is at $105 and it's a $115 call, so the call isn't worth anything. So the total amount paid would equal the total amount received, and the investor will have broken even at $105. Well, that wraps up our discussion on fundamentals of options. I hope you'll join me for the rest of the Series 7 programs. And remember to contact your local STC branch for help. If you'd like additional materials, call 1-800-STC-1223. And thank you from Securities Training Corporation.